All right. Hello, everybody. Welcome back to another market open. Now, today the markets are not open in recognition of Juneteenth, but nonetheless, we thought it would be important to discuss some things that are going on in the markets because there's a lot of things going on in the markets. And I need some help analyzing what's going on in the markets because I can't fully analyze everything. So I have my good friend Chris Patel here helping us analyze stuff. Chris, I want to talk specifically to you about the housing market, some of the stuff you're doing with energy. I saw something new today that demand is dropping for oil or for some form of gas. I have to check the exact tweet I saw. But before we get into that, we'll give a time for people to get into the stream. How are you feeling about the market as someone who has six figures in the market? How are you feeling about in general your portfolio?
I'd say we've still got a little bit of pain ahead. I think a lot of people are kind of getting used to this whole like recover right away situation because what's happening is we've always had these V-shaped recoveries over the last like almost 10 years because every time anything bad happens in the macro economy, the Fed kind of just comes in, throws money at the situation, lowers interest rates, does whatever it has to do, and then boom, everything is fixed right away. The problem is this time around, majority of the reasons why we have the problems out there is because the Fed was too generous in the past, right? So it's almost like trying to help somebody, right? Where if if they're down and out, you should try to help people, but don't get them so used to it to the point where every time there's anything, going on wrong with them, you keep giving them more and more and more, and they become so used to it. So our economy has almost become, it's almost like we need to let the training wheels off of our economy. Over the last 10 years, all we've done is every time like we're about a little bit shaky, it's like, go ahead, put the wheels back, the wheels back on. So right now we're in the phase of taking a few bruises and cuts, and I don't know. It might be a little bit more drawn out than people are expecting. I don't think we're at a bottom yet.
Do you think the market has been artificially like this 10 year? I know the past 2 years has been artificial, but the past 10-year bull run, like, do you think the markets have been kind of propped up? And if we did have interest rates higher the past 10 years, we wouldn't have as good of a market as we did?
Well, I mean, I so here's the situation that we have to remember. 2000 when 2008 happened, that was like, believe it or not, that was almost depression level stuff, right?
Yeah.
So luckily the Fed came in at the time, printed the money, bought all the mortgage-backed securities in the market, recapitalized the banks, got the economy where it needed to go. The problem is that created almost like a sense of, hey, the Fed is always going to be here to catch us when we fall, right? And no one's had really the balls to kind of like go against that. There was some periods of time where the Fed kind of like was tapering off a little bit, but that ended up not doing so well, and we ended up going right back in. So if you remember in 2018, the Fed started to raise interest rates again. But then what happened was we had the taper tantrum and the market crashed. That year we had really bad returns, and the Fed went right back into easy monetary policy again. So
Right.
so I
And
don't
that
think
can't happen this
yeah,
time, is what you're saying.
no, because the thing is, before you were able to print the money. So the way that the way that the Fed prints money and injects it into the economy is not by, printing a whole bunch of dollars, like out of thin air and just going and giving it to people. That's not how it works. What they do is they actually print a well on their books, they print a whole bunch of dollars and buy up securities that are already exist. Most of the time it's in really safe assets like treasuries and mortgage-backed securities. During this time, they actually even had some money laying on the side for some corporate bonds that they were going to buy through an ETF, but they didn't really do that much. But essentially, they're buying it. They were buying a ton of mortgage-backed securities, right? So one of the reasons why we had, everyone's always asking, well, how come right now all these banks were willing to lend me money at 2.75 or 3% over for the next 30 years? Like that's crazy, right? Considering that inflation nominally every year is supposed to be around 2%. So
Right.
which banks are willing to give that kind of money out? Well, the thing is, they weren't. Most of that was the Fed kind of saying, okay, you know what, we'll get your back. Every time that all these like loan originators, what they would do, like Rocket Mortgage and Loan Depot and all these other ones,
Quicken
they would
loans.
give you, yeah, they would give you the loan, and then they would take it and sell it, right, to Fannie Mae, Freddie Mac, and then they would repackage it, and then the Fed would come in and buy that mortgage-backed security, right?
Right.
Now the problem is you have all these loans that are yielding 3% nominal, 3%, but at the same time, inflation's running at 8, right? So would you do that? Would you lend me money at 3% when you know inflation's running at 8? That
No.
makes no sense, right?
Right.
So right now we're at a point where the Fed is no longer doing that. Like now they actually have announced it, like we're not going to do that anymore. And instead they're actually rolling that stuff back out. So they're actually in the process of letting these things expire and possibly even selling a little bit. So, it's something that people haven't really taken into account. And with higher
Let's see
rates
this
of interest.
question. If the Fed's
Yeah.
policy becomes nothing, why are people worried about higher interest rates? Shouldn't we be indifferent?
Well, if you own an asset, right, that basically is appreciated thanks to the downward trends of interest rates, then that's something that you should be worried about. So, an example is anytime you see prices, especially for housing, right? Housing is an asset. Um, but there's two ways that you can raise the price of an asset. By making it more valuable, you can do two ways: an artificial way and an organic way. The organic way is it becomes it becomes something that more people just want, right? And there's a limited supply, and that's what happens naturally, right? That's an organic process, but what happens. Now, the thing is though, if you have a home that's worth, X amount of dollars, and there are a tremendous amount of demand for it. Back in the day, there was no such thing as loans. Like I'm talking about like way back. Like you couldn't get a loan for a home. Like it was just you paid cash, and that's like the most accurate way of valuing a home, where you couldn't take any debt, right? It's
Right.
all based on market demand. But then, people started getting loans and everything else. So now a lot of the stuff is based on loans. So if you have a home that's worth, let's say, 500,000 at 10% interest, right? Let's say you lowered that interest down, let's say you lowered that to like 5%. So you pretty much cut the interest rate in half. That means your mortgage got, if you refinanced it, would get cut in a significant portion, which means that you could afford a bigger home, right? Or the value of the home that you currently occupy goes up in value, because now any new prospective person it's going to be buying is going to be buying at a much lower interest rate. So we're at a point right now where things are a little bit artificial, in that the Fed kind of helped what do you call it, keep lowering rates to the point where the asset prices went out of control. So if you look at certain areas in the country, the assets literally have appreciated almost double digits for the last 4 years. Like it doesn't make any sense that a home that was sold in 2018, 2019 skyrockets to almost like 40% in less than a few years. No one's like, as far as I know, no one's making that kind of money where they've
They didn't
increased
make
their
it. They
income
didn't put
40,
a pool in the
50%.
back of the home. They didn't make it better, right?
Yeah. Well,
Okay,
the
so
other
I have
thing
a
is,
question then.
yeah.
Go ahead.
Mhm.
Go ahead. Last thought, and then I'll ask a question.
No. Well, the other thing is like that doesn't like that doesn't take away from improvements in the neighborhood, right? So sometimes the regions can get better too, right? So if you live in an area that's developing, a lot of people are moving into, the school districts are really good. That means that more people are going to want to move there. So there are effects on prices of homes going up that are indirect to all the artificial stuff. So like I said, it's organic versus this juiced up fed like steroids. But go ahead, yeah.
Do you think, but before we talk about housing, do you think that the Fed's artificial pumping of the economy has also led to the exponential rise of crypto? So we saw Bitcoin crash from 69K all-time highs last year down to 17 a couple days ago. A lot of people have been liquidating because they started to realize what's really the value of this asset. So do you think if the Fed didn't pump a lot of money, that crypto would just be in the same 2,000-3,000s?
I mean, I think a lot of people had extra disposable income, especially if you're giving people stimulus checks, right? A lot of what we saw the run up in the last couple of years was mainly due to people buying in with a lot of crypto with free money basically, right? So yeah, if you give people free money, people are going to treat it like free money. It's not something that they budgeted for. Like the one thing that I feel is like really terrible is like in terms of education on finances, I don't know if you remember in high school, they barely ever taught you the stuff that you needed to actually know and learn in order to get somewhere, right?
Mm.
I feel like if we had done that, more people would have been smarter with it, smarter with their stimulus checks, and instead of putting it into like crypto and stuff like that, they could have paid down their debts a little bit. They could have done more, you know, savings. But I don't know. Like I think that the way that everything's is set up, yeah,
The
I
reason
think
I'm
there's a
asking is
lot of
because
money
if
out there.
crypto's crashing, like Nasdaq stocks are crashing, and they're crashing because the Fed's pulling the rug. Like it seems like if the Fed never gave them the rug, then crypto would never have exploded like it did before.
I don't think so. There's always times where people are, get super bullish on certain
Gold
things
rush.
and they just go up regardless whether the Fed is giving money or not. Like, yeah, like the gold rush. Then you had like I could tell you like 10 different things, like marijuana. At one point, marijuana was like, I think in 2018, everyone and their mother was buying pot stocks, hoping a legalization would go in and they could become instant pot millionaires. Then you had a period where everyone was buying EV cars, right? So all these companies, like even if you didn't have an electric car out there, you saw Tesla and you were like, "Oh my God, this is the next Tesla. Let me buy money into it. Let me put
Mm.
money into it." So you're always going to see new industries that are coming up that a lot of people are like, "Oh my God, this is a game changer. We need to get in before it goes crazy."
Do
Expecting
you
that
do
that
you own
happens.
any Bitcoin?
I don't have any cryptos.
Why?
No.
Why?
Huh?
Why?
Well, for a couple of reasons. Number one, it never fit into my investing style. Like I'm not so much into like super risky stuff. Um I want to understand it. And even though I think I understand Bitcoin to a good degree, I think there's still a lot to be said about it. If Bitcoin does crash hard enough, I may end up taking a speculative position only because so many other big name people have kind of like thrown their hat into believing into it, like the Jack Dorseys of the world, the Peter
Elon Musk.
Thiels of the world, Elon Musk of the world. So if they're saying that, hey, this is something that's special, then I have some level of confidence in their ability to at least somewhat project something out, right? So right now I'm not invested in any Bitcoin, but if it drops far enough and I feel good about it, I may throw some money at it, but only as a speculatory like investment. Nothing too crazy that I would break my bank over. I did, however, own some crypto that I sold early last year, only because like I was just like, wow, I mean, whenever you see huge run-ups, you should always take a little bit off the top. So that's what I did.
Got it.
Yeah.
Okay. Housing market. You've been kind of vocal on Twitter about the housing market crash that is going to happen. Can you explain what do you mean by that, and what variables are you seeing in the market that lead you to believe that it's inevitable?
So I would say, you know, it's not going to happen. It's happening. Like right now, we're in a point where you're already starting to see price declines in certain areas and certain things. The one difference that we have from this time around versus 2008 is, I think, threefold. Number one is the regionality, right? There are certain regions that kind of went a little too crazy with the housing. Um, if you look at like the value of homes in certain areas, they've appreciated way more than other areas. So if you look in the New York and New Jersey area, we our prices went up, but not crazy amounts like they did somewhere like in the southeast, right? Like I live in
Right.
Atlanta and I have a place in New York. My property in New York went up, but not that much. Whereas my property down here in Atlanta went freaking eight like bananas. Like literally some homes that were selling for 300,000 are now selling for 600 and even almost 800,000. A lot of that is because of the way that people were just starting to like realize, hey, with COVID, let's move somewhere that's a little bit less restrictive. We can work from home. And Atlanta is a really nice place, like especially if you go to like the northern suburbs where I'm primarily located. It's a really beautiful community. It's great. The problem is the pricing of homes is just out of this world right now. And that seems to be the case for like a lot of other cities in the country where a lot of people moved to because of the COVID restrictions, and also because the expectation was that people were going to be able to work from home indefinitely. And I think that's kind of reversing a little bit. Like when I see a lot of people in New York, you know, a lot of companies, they realize this work from home thing can work as a hybrid model, but it can't work as a permanent solution. Like there's just so much more value in having that collaborative um face-to-face content, like contact, that you can't naturally and organically reproduce on a Zoom call. So I think a lot of people got used to that, and I think I think everyone was thinking that was going to be here to stay. I do think a form of it is going to be around where people are going to be able to have a hybrid work situation where there's a certain number of days they can work from home and a certain number of days where they can come into work. But the whole notion that you're completely going to be dislocated from work, you never have to come to work, you can just do it from home all the time, is it's not going to happen. So let me go back to the other thing. So number one is certain regions appreciated way more. The other thing was, over the last 10 years, do you know what iBuyers are? Yeah. All those people, for anyone that doesn't know what iBuyers are people who are usually backed by someone like Wall Street, and they come to they come to the market and they do all cash offers on homes, right? So after the crash in 2008, there's a lot of single family homes, especially in the lower ends, that were put on the market, right? And these Wall Street guys, at the time, they were starving for yield. So what did they do? They ended up pooling all this money together, backed by corporate debt, backed by low interest loans that they were able to get because interest rates were so low. And they bought all these single family homes. They renovate them and then they rent them out. And they were making money like that. And it was profitable, right? So you had two layers of profit that they were making. Number one, they were making money on the rent, but they were collecting a certain gross margin from the rent. And then because the property market started to recover, they were making money on the asset appreciation. So if you bought a home that was 200,000, right? And then the next year the price of that home went to, let's say, 220, right? You ended up making a 20% return on something that you leveraged for less than 2%. So you gained a good amount of money in just literally property appreciation. So over the last 10 years, this industry has been growing considerably. So a lot of people have been kind of like throwing, like a lot of Wall Street has been going in and just buying up all these homes. So a lot of homes that would have gone to like that are primarily for starting, people starting their lives. Like you right now, you're still starting your life. You're in your early 20s. Let's say you find a girl, you get married. You're not going to buy a $700,000 house unless you have like a mature income. You're going to buy a starter home maybe in the $200,000-$300,000 range. And then after 10 years, you build enough equity, you sell the place, then you would buy a bigger home. Something. Me and my wife were in that process, right? We have multiple properties. We bought around 2011, 2012. She had just graduated from pharmacy school in 2016, 2017. So I ended up buying a place here. So you can see that we slowly have built equity into our balance sheets. So now what happens is when we sell these properties, we can now take on the ability to buy these bigger homes. The problem is a lot of people right now, especially at the lower end, they've been priced out completely because number one, all these iBuyers came in, bought this stuff cash. So there's very little inventory that's out there that's in that price range, the 200 to 300,000, even $400,000 price range in most areas. So a lot of people that are in our position, where if you're a first-time home buyer, you don't have necessarily a lot of equity, you're not going to be able to afford a $600,000 mortgage. So what's going to happen, right? So number one, the problem was these iBuyers. They got into the market. Now they have all these single family homes that are up for rent. And it's I think that's like the first bubble that kind of started to just creep up on us. We can't hear you. Sorry.
Oh, sorry, my mic was muted. This also happened with Zillow, right? Their iBuying business collapsed, and this was like the first sign that
Yeah.
happening.
So Zillow kind of did what their business model was about was they were going to buy a home, right? They were going to renovate it and then they sell it, right away. So essentially what they wanted to do was leverage their platform to identify areas where they could theoretically make a return. Now here's what I've heard in terms of it seems conspiratorial, but at the same time, it does seem logical. What Zillow did was, let's say they would go into a certain area, they would buy 10 homes for like $400,000, right? So
Yeah.
each house that they would buy is worth $400,000. Then what they would do is later on, they would go into that same area, buy a home for 500,000. So what ends up happening is the comparables in the area, right, all become, oh shoot, a home in this area was sold for 500,000 that's comparable to the other 10 that were bought last year for 400. So what are all those houses that were worth 400? What are they worth now? What do you think? What are they worth now?
A lot more.
500,000, right?
Right.
Because that's what the area is quoted for right now. So now all of a sudden Zillow can sell those homes for 500,000 and make $100,000 profit per house in that area. You see,
Right.
without doing real much. And so one of the falsehoods that I ended up seeing was these things called Zestimates, right? Where basically Zillow was giving an estimate of what your home was worth. And people kind of just swear by that. And they're like, oh my God, my home is worth twice what I paid for it. Like the Zestimate said so. Now, I don't know what kind of algorithm that they were using to get these estimates, but a one bedroom, one bathroom condo in my area was sold for almost $260,000. That was sold literally almost like for like $80,000 during the market crash. I think even less than that. And what happened was there was, in order to kind of like save on the time and save money, Zillow was actually
Offered a
buying
premium.
homes, huh?
At a premium.
Well, not only at a premium, but dude, they weren't even inspecting these homes. They would literally just, give you an offer. Like regardless, they wouldn't see the inside. There's no appraisal process. There's nothing that the normal way to do it, because their logic was we're going to flip it so quick. We don't need to look at anything. And so they were buying into a lot of homes and without really looking too much into it. And yeah, and then they ended up getting burned by it. Like if you saw, they lost a tremendous amount of money. But the one good thing about Zillow is that they realized that they messed up and then they got out very quickly.
Right. Right. Shout out to Jay Shawat 93 $2 super chat. Thank you so much. A lot of people in the comments saying there's a lot of building, but nobody's building starter homes. Lots of apartment buildings, lots of McMansions, no starter homes. That is true. It's bizarre that so many would assume that work at home would be permanent and pick up and move so quickly. That's also true. I guess people just thought something was totally changed during the pandemic. Thank God you're live today. I was wondering what to listen to at work since the market is closed. Well, you can listen to me and Chris. Okay, Chris.
Yeah.
So mortgage rates, so the housing supply is down. You've established that argument. As a result, mortgage rates have increased to like 6.7%, I think was the last right?
Yeah. So here's where things get really interesting. These iBuyers, the one thing that they did not do, if you look at the average price of homes that they bought for, was 200, 300,000. The reason why is because there is let me take, I'm going to say something that's somewhat controversial that not a lot of people are going to like, but it's worth saying. Single family home ownership is not profitable. Okay. Anyone thinking that, hey, I can buy a $700,000-800,000 home and that's going to be a future asset, I can tell you right now, if you're planning on buying it to live in it, dude, you're gonna be fine. Like you are good. But if you are planning on like using it as some kind of like you thinking of it as an investment, dude, no. The reason for that is because number one, let's say you bought a home that's a $600,000 home and you rent it out. How many people do you think are in the market to rent $3,000-4,000 homes? It's not a lot of people, because at that point, people would just, especially at that income level, would end up just saying to themselves, wait a second, why don't I just buy a home myself? Right. So a lot of iBuyers that they were going into realized that, and they were only hitting the starter homes. Now that they've run out of starter homes, the thing that they're doing is doing something called, and this is something that if you look up on CNBC, you'll see it's called build to rent, where essentially they're buying land and just building all these homes in a community with the purpose of renting everything out in the area, which which works for them. But at the same time, what about all these McMansions that literally Zillow appreciated to almost 600, 700,000? From my In my opinion, a lot of them are going to go down significantly because a lot of people don't necessarily take in the cost of home ownership. It's significant. Like, you have all sorts of maintenance that you have to do on the home. You have to do gardening, all this stuff. The property taxes are always going to go higher, right? If you have a roof, it's a 20-year roof, which means that eventually if you have to replace the roof, it's going to be a buttload of money. The water heater, all these things that you have to do to maintain a home, those are expensive. Those really expensive things that you have to do. So when it comes to renting, it's a lot more riskier to buy a really expensive home and to try to rent it out rather than something small that you can rent out very quickly. So I think if you have a home that's like 200, 300,000, that's a starter home, I think those are going to maintain their value for a good amount of time. Um, but if you own, let's say in the last couple of years, a home that's worth, like really in the I would say probably in like the $700,000, depending on the area. Let me rephrase. Depending on the area, I'm talking about Atlanta area, like where I'm used to seeing $400,000 homes. If they're 800,000, there's level of like overvaluation that's eventually going to correct, that's going to come down. So each area you're going to have to like kind of see from a regional perspective what level of appreciation has happened and how you're going to how we're going to see that. But I think there's been enough appreciation over the last 4 or 5 years where we're going to see significant declines in the housing market, but maybe
So
not
the
maybe not to the
interest
level.
rates
Yeah.
rise because of the lack of supply, essentially.
No, no, no. The interest rates rose
They're the
because the
mortgage
Fed.
rates.
Yeah, the mortgage rates rose because the Fed. If the Fed, remember, is where the banks are going to be judging how much money they can get from other things. So here's an example. I'm a bank, right? If I can go to the Federal Reserve and borrow money at a super cheap rate, right? I can use that as a point to discount to when I lend it out, right? Also, that mortgage-backed security, right? It's all dictated by the Fed right now. As the Fed raises interest rates, that's when mortgage rates are going to start going up.
So
The other
even if
thing,
mortgage rates are at 6%, you're saying that the prices of houses have to collapse because no one's going to pay 6% on a 30-year mortgage, right? Unless the price of the house is really good.
yeah, yeah.
And if it's not really good, then they're
Well,
not going to do that.
it's more dependent on the median income of an area, right? So if you look at a certain area, look at the median income. So if you have a household median income of about $100,000 in an area, the people in that area can only afford a certain amount of mortgage, right?
Yeah.
So if you think about it, if you think about a house that's worth, $500,000 that was, at 3% interest, they could afford that home because guess what? That made sense in terms of income and everything else. But if you turn that interest rate to 6%, you're almost doubling what they're paying in interest payments, right? So now that home has to come down in value for those same category of people to afford it. So it's not necessarily about just the interest rates, but about what people can afford. If you look at the charts for like the Schiller index on housing affordability, it's the lowest it's ever been in the history that I've seen the chart. And that's the thing that's really bad because when people can't afford the homes, people are naturally going to not buy them. They're not going to be able to get a loan for it. So that's what's happening. So a lot of people that are in the market to sell, they're going to have a rude awakening and a rude realization over the next, I think probably in the next 2-3 years. And the prices of homes might end up coming down precipitously. I do know that there's a lot of people that refinanced into like 3% mortgages, which is what I did too. And also bought homes when the prices were, like the interest rate was like 2.75, 3, 3.25.
You bought yours in 2020, right?
No, well, I bought my condo in 2012, the one in New York, and my condo here in Atlanta, I bought in 2017. You
Okay.
know, yeah, so they were a lot more reasonable at the time. But I refinanced and basically took the money out and just put it on the side. Like right now, I have a good amount of cash that's sitting in a bank account right now, not doing anything. I'm not invested in it because why would I? Basically, what I did was I had a whole bunch of equity in my condo. So I said, okay, I see inflation coming. So what am I going to do? So I took, I refinanced with 30-year 3% mortgage at the time. And now I'm just taking that money, putting it on the side. Right now, if I want a mortgage, my mortgage would end up being 6%, right? I could take that money and even put it into a decent bond fund and yield 10% on it, which
Mhm.
is kind of crazy that I'm borrowing money at 3, making 10 and basically pocketing the 7%. But that money I'm going to be using towards housing when I have it. So now all I have to do is sell my property in New York, take the equity from my apartment, my condo here, right? The loan that the money that I have for that, and then just buy a nice home and not have a crazy mortgage,
Are you thinking of
So,
selling the New York property? Like, did the prices go up? The estimates go up on that?
not really, not that much. The difference with my apartment in New York is that the area that I bought it in improved substantially. So I live in Williamsburg. So if anyone here is from the New York area, I bought mine in around 2011, 2012 when the market was crashing, and then a lot of people moved into the area. The area started becoming a lot of developers moved in. And so the area became much nicer, right? There's a lot of gentrification that happened in the area. So the price of my apartment went up considerably. But like I said, that was more natural than the other thing. So that was an organic increase. So if you look at even the median income in the area that I bought, it's going up tremendously, right?
Mm.
So, irregardless whether the interest rate is going up or not, if you have organic appreciation, you're always going to do well. So that's my New York apartment, where now all these other people are starting to move into the area. They have higher incomes, they can afford more homes, so this way they'll be able to buy it at a higher price. Do I think that I'm going to get a little bit of a hit in terms of what I could have sold it for, uh, like last year versus what I'm going to be able to sell it for in 2024 or 2025? Yeah, I think I probably could have gotten more, but it's not going to go down as much as someone who had bought into an area that wasn't exactly changing rapidly.
So
So
when
yeah.
the housing market does crash, do you think, like, who's gonna benefit from that? Just consumers that have been waiting to buy? Is that the main thing?
So I don't
Or like
think, yeah. So
when it
I don't
crashes
think,
as badly as it does, because you said it's already crashing, yeah.
yeah. Well, let me rephrase that just a little bit. It's not going to crash like we saw in 2008. 2008 was a fluke in that there was just a lot of lending that was happening to people that could not like theoretically get a loan, and they were not credit worthy people. This time around, it's different. Where what's happening is it's a lot more based on overpaying for certain thing that doesn't matter, that you shouldn't have been overpaying for, and that's, believe it or not, more regional. So I think the people that are going to benefit the most are people that are kind of waiting on the sidelines, that understand the housing market that they're trying to buy into, right? So for me, let's say I'm trying to buy a home in northern suburbs of Atlanta. I know that the value of homes are overvalued there. There's people right now that, you know, thought that work from home was going to happen, where now they're starting to go into work. There's been a significant influx of tech workers because if you look in the northern area of Atlanta, there's a lot more tech companies that came in, especially like some of the startups and stuff. As they kind of start to, I don't want to say go out of business, but as they decline in their business and they start to lay people off, a lot of people are going to end up having some dramatic shifts in the ability to generate income. So
Yeah.
if you have a home, even if you have a low interest rate and you're a two-person household, if you lose one income, that's a significant decrease in your ability to, pay for that home. And if the partner can't get a job right away, the first thing that comes to mind is, okay, what can we do to, decrease our monthly expenses? And usually the biggest monthly expense is a mortgage. So sometimes people be like, okay, you know what, let's sell the home while we still have some equity in the home and move into like a rental, right? Or if, let's say, you have to, or if one of you guys has a better opportunity in another city or another state, people are going to sell their home to go out there. So I think we're in a very dynamic place in terms of housing. So I think a lot of areas that benefited significantly over the last 2-3 years, I think those are the areas that are probably going to see the bigger declines that are out there.
Hmm. It's interesting because it's like that the housing market's going up, or like the housing market was going up while stocks were crashing over the past 6 months, and now it's just like all the dominoes eventually have to fall back um, into place, and everything has to kind of go back to normal. So, I guess how long do you see the pain kind of lasting over the next 18, 24 months? The average bear market I saw is 10 months, 18 months if you really extend it. Um, so in 2008, it took the S&P, I think, 4 or 5 years to get back to the same levels it was in 2007. So do you think we're at that kind of level, or do you think because the hyper growth nature of tech is now here in 2022 that it wasn't in 2008, that when we recover, it's going to be a real recovery because these companies obviously are pretty phenomenal?
Um, I I'm probably leaning towards a more extended downward trend, but it's all going to depend on the Fed, to be honest with you. There's the way that the Fed should have been doing this is, number one, the minute they saw a little bit of frothiness in the market, they should have started raising interest rates. What you do by raising interest rates is you stop the speculation, you stop all these people from going crazy with houses, right? Like a lot of people bought, not like one of my friends bought not because he needed the house. It's because the interest rates were so low. He was like, I don't think I'll ever be able to get an interest rate this low. So I'm going to buy this all. I said, bro, you and your wife, there's just two of you. You don't need a 6-bedroom McMansion. He's like, yeah, but I don't think I'll ever get an interest rate like this again. So I'm just going to buy. I was like, aren't you worried that, like, if rates go up, things will go down and blah, blah, blah. He's like, nah, I'm willing to take the risk of not getting into a home at an interest rate like this. So I was like, okay, fine. To me, in my opinion, you're almost like putting yourself in a position where you're a slave to that home for the next 30 years. Because
Yeah.
if you're, even though you have a low interest rate, what happens is if the price of that home goes down, you're still going to be paying the bank the entire way, right? You're going to be paying that 3%. You feel good because you're like, yeah, I'm getting over the bank. But if the asset decreases in price, then that's pretty I mean, eventually he'll make his money back. Like he plans on living there for the next 30 years, which is fine. Cool with me, but I I I don't think anyone is stable enough to stay in one place for 30 years. Like, especially in this kind of economy, not just this economy, but the world that we live in now, where things are a lot more like flexible in terms of like moving around. The opportunities are in some areas and they're not. So, I don't think this is like the 1950s where, your dad got like a job at the steel plant and, the guy worked there for 30 years.
Yeah. No, it's interesting. It's kind of crazy. This is and everything you're saying, it's so new to me about it depends on the Fed because obviously I'm 24. 2008 really didn't make sense to me. 2020 was the first time I saw a crash, and that it was gone after like 2 days, and then everything just kept going up. And I was like, "What crash? This is not a crash. This is a bull market. This is great." And then you realize, well, wait a second, it's happening because there's a lot of stimulus checks being printed. It's happening because a lot of the Fed is pumping up. So it's like none of it was real. None of it was real. And this is my first time I'm dealing with a real market bear down and seeing how
Well,
it goes.
well, you know the saying, don't fight the Fed, right? Well, don't fight the Fed on the way up, but guess what? Now the Fed is on the way down, so don't fight the Fed on the way down. So buying equities right now is like fighting the Fed on the way down,
Right.
right? So before it was don't short stocks when the Fed is out there buying all this liquidity and dumping it into the market. So if you're a real believer in that saying, then yeah, right now is not the time. The Fed is, slowly deleveraging themselves. They're lowering their balance sheet. At the same time, they're not buying any more mortgage-backed securities. They're raising interest rates. That's not a healthy, that's not something that you're going to see a V-shaped recovery on.
Right.
and then energy prices are relatively high right now. And there's been the lack of capital investment in energy. So people think that magically you could just turn on the taps and more oil just comes out. No, it takes capital projects. You gotta invest, and you have to, and the time cycle to seeing oil after you invest in the infrastructure,
Takes time.
it takes time. So there's no magic wand that's going to see oil come down to like what we saw 2-3 years ago. So I would say we're in a few years of pain that I don't know. Maybe something will happen. Maybe I don't know.
Theo says, congrats on 13K subs, man. Thank you so much, Theo. I appreciate that. Saul says, my concern in the market is that as jobs slow down, people won't be able to continue making those same payments and lead them to sell in a year. That might also happen as well. Last question I have for you, Chris. I saw a tweet that said Tesla is a pandemic stock that never fully came down. Like we saw Zoom went all the way up and then it came down, and a bunch of these stocks, DraftKings, they said Tesla is the same. Do you agree with that? Do you think it's time for Tesla to get back in the $200-300 range and recover from the pandemic?
No, I don't think so. I think too many people still see it as like one company. Like I think of Tesla almost like a conglomerate. They've got so many income generators out there that are outside of just their traditional EV. It's like, all right, they own all their charging stations, right? All the money that's getting generated from all their superchargers, that's one. Then you have Tesla Insurance. That's another product, right? All the repairs, all the servicing, all that stuff, there that's another revenue driver, right? Also, any of the repairs that like the parts, the stuff, Tesla makes its own parts. It doesn't like third party the sources out. That's another one on top of all the car sales. So they're fully vertically integrated and they're still expanding, right? They're not a mature car company. They've got a long ways to go. Like they still haven't fully ramped up production in Germany yet. You know, we're moving towards electrification. Tesla is doing the best in terms of electrification. So it's the same way that you saw with Apple with the cell phones, right? Where everyone's like, okay, this new industry comes, everyone is buying cell phones, right? Apple is one of the players in the cell phone game, right? The point at which all these people ended up having cell phones, everyone's like, oh, yeah, well, Apple's overvalued now because where else are they going to sell their phones? Well, guess what? They make the best phones. So people are willing to pay a premium for it and ended up going it. I don't see too many electric cars right now that can compete with Tesla in its fully vertically integrated model right now. Maybe in the future, other car companies will come and start eating away at market share. But from what I can tell, Tesla right now, no one is saying, "Oh yeah, I want to go buy a Hyundai Ioniq versus a Tesla Model 3." And Tesla is doing just doing a bang up job. Like a lot of the process that they've come up with are amazing. I mean, I don't see them getting kicked off the throne anytime soon.
Do you think the
They
valuation though was the issue? Like it was $1 trillion in the pandemic and now it's coming back down a little bit. Do you feel like that is why it needs to go back down to normal to some extent?
Yeah, I mean, I think for Tesla, it's all going to depend on future growth prospects, right? Like as far as I can tell, the future growth prospects have not slowed down at all, especially based on the last quarter's growth. Dude, I haven't seen it. I don't. Dude, which car company do you know is growing at 81% a year on
Yeah.
revenue, and they're growing their bottom line at the same time? Not many, if any, to be honest with you. So somehow Elon Musk was able to navigate a lot of the supply shortages, a lot of the worker issues, and be able to come up and actually still make a significantly profitable product. And there's a little bit of, there's some value to that a lot of people don't necessarily see with some of the other car companies out there. So I think that when I look at Tesla, I see a technology company that still has a lot of room for growth. And the one thing I wouldn't do is bet against a company that's got dynamic CEO like that still has a significant, like they're nowhere near market saturation for electric
Yeah.
cars. And if they're the best category, they're the best ones in the category, then that you should significantly value them because of that, you know. Yeah.
I agree. All right, I think that's it for today. Thank you, all of you, 140 of you, joining the Market Open. Chris's Twitter is in the description. Please definitely check him out on Twitter. Gets a lot of good advice and tips around what's going on in the market. Thank you guys for someone just said amazing channel just got, and this is why I like YouTube, because so you can actually discover new stuff, and then we can get your attention, and hopefully have a good content relationship with the viewer. So thank you guys for joining. Chris, any last advice for this market?
I would say the best thing that a person can do in this market is, if you have some debts, clean them out, get rid of the debts, like work on getting those debts. Like, there's no sense in paying a credit card company 17-18% while you're trying to eke out a 7-8 maybe 10% return in the stock market that even hedge funds have trouble doing. So if you've got credit card debt, get rid of your credit card debt. If you have high interest like loans on anything, get rid of those. Save your money. There's some good opportunities that are going to be coming in the next few years. Save your money, recapitalize. That's all anyone can do. Anyone that's taken a hit in their portfolio over the last 6 months, it's not the end of the world, especially if you're young, because the longer you're in the market, the more money you'll end up making in the long run. So yeah, don't freak out. Don't go crazy. I know a lot of people. I was a young investor at one time in 2016. I lost a good bit of money on some oil stuff that I had. But guess what? Time goes on, you recover, and you learn from it. So anyone right now that got caught up on the wrong side of all of this stuff, dude, just relax. If you stay in the market, if you keep your head on a swivel, you look out for all the indicators that are out there, you'll be fine. Especially if you're young. If you're older and you lost a ton of money, sorry, that's just a really difficult place to put you in, because the one thing you can't get when you're much older is time. So, but essentially, a lot of people, hopefully, if you're much older, you shouldn't have been taking too much risk in the first place. If you're like 60 years old and you're putting all your money into Dogecoin, God, that's bad. So, yeah, I think Amit, you're a young guy. You've got years of growth ahead of you. Hopefully, Palantir ends up going to the moon, and somehow you end up retiring. Well, no, I mean, you've got Aldea too, so that's you're doing
startup that Chris is putting a little money in. So hopefully I can make Chris a rich man in like 7 years.
Who knows? At the end of the day, when you're young, you have the opportunity to do more, right? And to take bigger risks. That's what you should be doing. Everyone who's in their early 20s, you should be taking more measured risks than when you are in your 50s, 60s, and even, I don't know, some people in their 70s are investing in the market. But yeah, I think that's where it is.
All right. Love it. Thank you so much, Chris, for joining us. You'll definitely be back on again, another Market Open.
Yeah.
And we'll see everybody next time. Thank you, everybody, for joining.
All right.